Welcome everyone, and thank you for joining us for the webinar An Entrepreneur's Perspective on the State of Venture Capital with our presenter, Nicole Staple. My name is Cassie Petoskey, and I'm the Assistant Director of Career Advancement for your Northwestern Alumni Association. We'll begin shortly, and we're so excited that Nicole could join us for this great topic, but first, a few housekeeping items I'd like to share with you. On the right-hand side of your screen, you'll see that there are a few different tabs there. Please send in your questions for Nicole through the Q&A tab, and we'll answer those at the end. You'll also see that there is a polling question on the right-hand side of your screen that's open right now, so we'd love for you to answer that and send in your thoughts through either the chat or the Q&A tab. Should you experience any technical issues during the webinar, you can email the Big Marker team for further assistance at support@bigmarker.com, and I will send that out to you all in a chat as well, so you have that email address if you need help. And lastly, a link to access the recording of the webinar will be sent to all registrants later today. Now let's move on to why we're all here. Nicole Staple is a co-founder and CEO of Brideside, a platform that delivers personalized and thoughtful experiences for life's most meaningful moments, starting with the wedding. In 3 years, the company has grown into a go-to destination for women all over the country with a robust digital platform and several brick and mortar showrooms. Nicole runs all finance and revenue generating operations, including sales, marketing, and capital raising. Prior to founding Brideside, Nicole spent 4 years in healthcare, investment banking, and technology venture capital, where she supported large M&A transactions and growth investments. She holds a Master of Business Administration degree from the Kellogg School of Management at Northwestern University, where she was awarded the Women's Business Association Scholarship, and also a Bachelor of Arts degree in economics from Wellesley College. I'm going to hand it over, and thank you so much for being here, Nicole.
Thanks, Cassie. Really appreciate it and excited to be here with you all today, albeit virtually. Looking at the poll now, if you haven't taken the poll, go ahead and do that now while I introduce myself. This will just give us a good sense of who's on the line today. Cool. All right. So let's dive in. As Cassie mentioned, my name's Nicole Staple, and I am a co-founder at Brideside. There's me right there. Before I get started, a little bit about the company. To give you a quick background on myself, just to echo what Cassie just told you about, I'm here with my co-founder, Sonali Lamba. We met while we were at Kellogg. We graduated in 2012. We became fast friends early on. We actually were in the same section when we started school as a business school freshman in 2010. We ultimately ended up launching our company out of business school. As Cassie mentioned, prior to my business school days, I had a background in finance, both in investment banking and venture capital at Silicon Valley Bank. At SVB Capital, I supported investments in early stage technology companies across several sectors. So part of the inspiration for the presentation today is really thinking about those years in venture capital and balancing the experience that I had there with my current entrepreneurial endeavors. And I hope that gives me a somewhat unique perspective to understand a company's growth really from both sides of the table. So my goal here today is just to share some of that insight with all of you. Little shameless plug here for the company, just to give you a little more background. So we're a company that really strives to be your champion during life's most meaningful moments. And as Cassie mentioned, we started with the wedding. Today, we're a group shopping experience for bridesmaid dresses and related purchases. And we provide bridal parties who live all over the country with personalized, concierge-driven service and amazing product. We allow our customers to shop online through our e-commerce site at one of our 4, soon to be 5 brick and mortar showrooms, or through our try at home program, which is similar to a Warby Parker style home try-on program. What makes us really special is that we're powered by a team of in-house style consultants that work with bridal parties digitally or in person to make sure that they have a go-to resource throughout the entire process to complete their vision and coordinate all of their bridesmaids. These stylists provide our concierge service to over 100 active bridal parties at once, and our technology has allowed us to do that. We're really just aiming to build a brand that women adore for celebrating this important moment together. We launched the company, we hard launched in 2014. We had been through a technology incubator after we graduated from Kellogg, and today we're about 40 employees and are on track to quadruple revenue in 2017. Our brick and mortar showrooms are mostly on the East Coast, with the exception of our big Chicago, and we're launching New York City in August, which we're thrilled about. And we've had a lot of fun thinking about and innovating on the showroom experience and learning how to create a fun and new experience for our tribe of customers, both online and offline, and something that really sort of blurs the lines between the digital and the physical. But that is not why we are here today. So I won't bore you anymore with my own company. Really, my goals for today are to go through 3 big topics. So first, I want to provide some useful information about the current financing landscape and just some quick trends that we're seeing, just so we can all really align on the environment and the data that we're seeing. Next, we're going to use this landscape to talk about how we as entrepreneurs can really think about our financing options relative to the business that we want to run and the outcomes that we're ultimately hoping for. And finally, I'd like to go through the face-offs that we face every single day. What are the types of business trade-offs that we have to consider in order to plan for the exit that we want? A quick caveat here. I want to mention first that everything I'm about to say is completely subjective. I make several generalizations throughout this presentation that are really for the purpose of not making this presentation several hours long. I recognize that no company is the same, and hopefully you can take all of my comments with a grain of salt and really largely a reflection of my own experiences. And the second thing I'll say is that this presentation, as you may have gauged, is really focused on earlier stage companies, because that's really what I know. I often think of our company as a super gifted young woman who's definitely growing up too fast. And those are the type of companies I'm going to talk about today. Sort of the younger companies who are really looking for their first financing or early growth stage financing. So if you're ready, let's do this. My slides here. All right. So over the past several years, venture capital as an asset class has very much grown in popularity. And this has led to a strong appetite among limited partners to invest in venture capital funds. We're seeing a rise in the number of dollars being invested in venture capital funds. And that's what this graph here shows. But what's interesting is that the number of funds themselves are actually not increasing at the same rate as the dollars going into the asset class. Limited partners are favoring larger funds that have proven returns and ultimately make their dollars less risky. So as you can see here, since 2014, the number of funds out there has actually declined by around 6% right here. But you've seen the number of dollars going into venture capital has actually increased by about 15%. So what does that mean? Well, what that means is that venture capital funds across the board are seeking larger investment sizes and larger returns in order to hit their growth targets. For example, a 10x outcome that returns 100 million in capital to the fund does not have the same impact that it used to. Fund size has gone from 500 million to $1 billion. Bigger fund, you need bigger dollars to really make a difference in that fund. A lot of these bigger size deals were actually driven by the rise of what we call the unicorn, as many of you are probably familiar with, such as Uber and Airbnb, who were raising massive venture capital rounds instead of going public at sky-high valuations. This was largely happening in 2014 and 2015. You can see these top 2 lines here. These are the size of rounds for later stage deals. So you can see there's a sharp incline there, whereas earlier stage deals, sort of your seed Series A deals down here, the sort of the level of investment was, relatively flat with maybe a slight increase. Some are saying that in 2016, VCs were actually sort of brought into a little bit more of a reality in terms of a valuation crunch. So investors in 2016 seem to have recognized that there was actually a pretty big disconnect between some of the valuations and round sizes that occurred in 2014, 2015, and that maybe some of these companies were sort of overvalued. I've heard some rumors in 2017 that there are some signs that funding may be shifting as big investors actually become more cautious. So very quickly, if any of you are willing to jump in here, I'm curious where you guys are located. If you wouldn't mind quickly in the chat or in Q&A, very quickly, just tell me, where are you coming from right now? Okay, we have South San Francisco, Asheville, North Carolina, awesome. San Francisco, LA, sweet. Okay, so it's great. We have sort of battle of the coast here, including some Midwest presence. All right, so where do we think venture capital is still highly concentrated? Still hyper concentrated on the West Coast. No guys there, right? 60% of venture capital in 2016, the dollars going in were still on the West Coast. This has not really changed much over the last decade, which I find actually interesting given a lot of the media buzz there is about technology hubs really sort of opening up all over the country now. Also, by sector. Sector investments are still pretty concentrated. 40% of VC dollars in 2016 went into software companies. Again, what's striking for me is that you actually hear a lot of buzz about consumer product deals, for example, but not a lot has changed in general and where VC dollars are really going. So what does all this data really mean for us as entrepreneurs and potentially investors as well? Well, first of all, in Silicon Valley Bank's poll in Q1 2017, executives think that this year is going to be harder in past years to raise capital. So what this is showing is the percent of executives that think fundraising will be extremely or somewhat challenging. It's hovered around 80%, and this year, almost 90% of executives thought it was going to be harder than in the past. But what do I say? My perspective is this. First, as we discussed, VC funds are requiring larger cash-on-cash returns on their investments, which means they're going to make fewer deals, be tough on valuation, and again, they're really looking for massive bets and massive wins. This is all to say that this is very rare, and they're looking for largely binary outcomes. It's either going to blow it out of the park or completely fail. That's the way, in many ways, that the model works. Because startup costs are just so much lower now than they were in past years, every single industry is also getting more competitive. This is driving heightened competition across the board for early stage funding. The number of early stage deals are staying pretty flat, but there are so many more companies launching. I've noticed that it has become harder to differentiate your business and your deal, particularly in the minds of VCs. Lastly, as we sort of touched on at the beginning, this definitely isn't an even playing field, which could be honestly a whole presentation in and of itself. As you saw, VC dollars are still remaining highly concentrated on the coasts. So the world of investors is just very small if you're not in San Francisco. Second, there's widespread consensus that there really is inequality across gender and race for venture deals. This is driven by conscious and unconscious biases as it relates to VC partners and their approach to the management team or the industry. And there are fleeting sector trends, things that are hot, buzzwordy, in the moment, and things that are not. The reality is many of these things are completely out of your control. So the reason I wanted to start with all of the data at the beginning was really to ground us in reality. I think that's so important for people who are either looking to join early stage companies or in the midst of launching your own. If I gave you a presentation on just how to raise venture capital, it would be pointless for a lot of you. And I think it's important for us to see and align on the bigger financing landscape. I want to make the case as we go through the presentation that there are lots of options for financing your business, even high growth ones. But it's important to plan early on so that you have the means to grow the way that you want to. So, friends, drive carefully. There is a lot out of your control, and I would know. In my experience, particularly in the consumer segment, I've seen a lot of startups just assume that they'll raise additional capital, and that's their primary strategic mission and growth plan. Everyone is raising angel capital to plan for the seed or Series A round. So let's talk about what your other options are. So I want to tell you a little story about myself, and it involves my dad, and he may even be on this webinar, but he doesn't know that I'm going to talk about him. So about 18 months, I was having a tough time fundraising and getting really down on myself and the company. It felt as if we were building this really different and exciting company, but I wasn't getting the fundraising traction that I wanted. I frankly didn't know what we were going to do, and I felt like I was running out of options. So I was on a trip, I believe it was over Easter, visiting my family, and my dad shared a simple piece of advice that really helped me reframe our financing path. There's my dad. He said, your job isn't to impress VCs. Your job is to take care of your employees and to build a big, profitable company. Now, this might seem super obvious to many of you on the line, and it is a pretty simple message, but I have to say that it allowed me to rise above a lot of the TechCrunch BS, a lot of the venture news, and really think about multiple paths to success. It drove me back to my leadership team to put more options on the table for revenue and financing. And it also allowed me to venture capital as one strategic option out of many. It forced me to put real time and effort behind a plan B and a plan C. I think it's important for CEOs and founders to realistically map out the probabilities of different financing options and the risks they face. And the types of results that you need to prove to hit your best case scenarios. So while it's certainly possible to pivot a company strategy or a product quickly, I found it's much harder to pivot on a financing strategy. It's because you run out of time too quickly. So major internal investments and operating decisions should reflect the true risk and opportunities that you face for financing. I actually think that entrepreneurs should be quite risk averse when it comes to this aspect of their business. I think there's a perception that entrepreneurs are big risk takers, but at the end of the day, you're your employees that come to work every day to move your vision forward. And I think you owe them a level of conservatism on this front. So let's dive into this a little bit deeper. I wanted to lay out a framework for you that hopefully helps define for all of us what the sort of businesses I'm talking about and what sort of outcomes we're really talking about. So let's go from the top here. I'm going to start on the left with what I've crowned, and not really me, what's largely known as the unicorn, the prancing unicorn. So yes, as we all know, these are billion-dollar exits such as Blue Apron, Airbnb, Uber. Outcome, as we're all well aware, is usually an IPO. And I think we're all very familiar with this type of company. The next type of company, is a really large range there, 300 million to $1 billion exit. I've labeled it as the golden ticket. This is a really, really big exit, but not sort of blow it out of the park, $1 billion plus. I would classify most good VC outcomes in this bucket. I cited a pretty massive range because there are a lot of considerations here, such as how much venture capital money has been raised to even consider if it's a good exit or not a good exit. But we'll say in most cases, this is a pretty good outcome, is a big outcome, and could be an IPO or an acquisition. The next bucket is the perfect marriage. This is a company that's really built to be acquired by a bigger player. The cash cow is, in my view, a large, profitable business that may or may not be a venture deal, but maybe a private equity deal that we'll get into. And the last, which is on the smaller side, is really what I call the good life. It's a lifestyle business that's profitable and allows the owner to live a very comfortable existence, but is looking to grow more steadily and more slowly. So for this first bucket, let's start with the unicorn and the golden ticket. In my view, if this is the outcome you're building for, we need to really lay some ground rules here. First, it goes without saying that your market has to be freaking massive, right? Like hundreds of billions of dollars. And if you're looking for breakout velocity by pouring dollars on the top, you need to go from nothing, a tiny company, to one that's growing 5, 10x per year or more very quickly. This often comes down to a single and very defensible competitive advantage that you can easily point to, whether this be on the management team, in the supply chain, or maybe it's a massive existing user base where the switching costs for the customers to leave are very high. Whatever it is, you're shooting for the stars, and success in your mind is inevitable. But for VCs, they're comfortable with a completely binary outcome. Either way, this is meant to be massive. They could lose everything if it doesn't work, but if it does, everyone's going to get super rich. This is definitely a venture capital deal. We're obviously talking about that here. You need massive high-risk capital to be able to accelerate your technology and marketing spend quickly enough to outpace your competition. Outspending your competition is an important strategy here if you're going to be the dominant player. Venture debt, also an option to complement the equity that you raise. This comes when you have a top-tier institutional investor on your cap table. You know, when I was at Silicon Valley Bank, I thought it was interesting. They actually evaluate risk based on the institutional investors that you have in the deal. They're actually more concerned with the quality of your other investors than the actual quality of your business, just because your business is so risky regardless. And they want to know that if you run into trouble, those VCs are either going to bail you out or pay them back. Let's shift gears to the second bucket. Perfect marriage and the cash cow. I grouped these together here. I think in the startup world, there's potentially not enough time spent in these types of companies. And it's important for entrepreneurs to plan for these types of outcomes. So for the ground rules, we're still talking about big markets, maybe not hundreds of billions, but still really big. Breakout growth maybe is defined a bit differently. Call it 2 to 4x year over year, maybe more. You're still growing quickly. You know, I often think about Drybar, the company, as a great example here, the women's blowout company. The company launched in 2010. It was doing 70 million by 2015. I don't know what the revenues are today, but you know, here's a really fast-growing company, a solid company that has multiple revenue streams with their blowout services and their line of hair dryers and beauty products. They're fueling growth through their brick and mortar expansion. You know, I would call, for all intents and purposes, a highly successful company, but one that may have not really justified the type of venture capital investment as we just described. There are lots of financing paths for this type of business. And I would argue that you actually need to be more conservative early on big investments in technology and infrastructure if this is the type of business that you think you'll be running. This type of business should be focused on strong early traction and a viable path to profitability. Once you hit those major growth milestones, the world is really your oyster. Maybe you decide to raise venture capital. Maybe you go the private equity route. But being realistic about your outcomes and truly creating optionality for yourself will go a long way. You'll have a lot of options. And there's a lot of paths here, from bigger family offices to high net worth individuals, to potentially business loans, corporate venture capital, private equity. All of these types of players require something different. Many of these types of investors are more conservative, but they have deep pockets. A few points on private equity, because I actually think there's some shift in the private equity landscape right now that I find interesting. As I mentioned before, valuations are starting to come down a bit in the bigger stage venture deals and the later stage companies. And I actually noticed that the data backs this up, and that private equity firms are showing more interest in earlier stage technology deals than maybe they were several years ago. There were a few big tech companies like Qualtrics and SoFi that went the PE route in recent months instead of venture capital. From personal experience, I've also found that PE firms are looking at even much earlier stage deals as well. And so I think it's interesting, but again, they're requiring sort of break even or a clear path to profitability. I did some surveying among my startup friends, and I actually heard something interesting, that private equity firms are pricing deals 25 to 50% below venture capitalists right now. One statistic I heard is that they're taking your current monthly run rate and applying a 2x multiple to that. So they're not really looking towards future projections. They're taking your annual run rate and putting a multiple on that. So given the type of ownership of the business that they'll be taking, it's imperative that if you think you'll go this route, you preserve your share in the company early on till you're ready for this type of growth capital. Other thing I've learned is that corporate VC is hot right now. It's on the rise as innovation and new technologies is affecting every single industry, from banking to travel to entertainment. Corporate VCs also want to get in the game and want a piece of this growth as really a long-term strategy for themselves, but they tend to be a bit more conservative on valuation and usually require a decent amount of traction to be considered. A lot of these paths take time to develop, particularly corporate VC. You need to build the relationships early on. You need to understand what corporations are looking for that's unique and highly scalable within their own corporations. You need to build relationships with the private equity firms that maybe are looking to go more early stage. So it requires some thought and some time. I want to quickly touch on the last bucket that I talked about before, which is the lifestyle business. I would assume we're all quite familiar with this type of business, but look, this business is really a profitable business, needs to be profitable early on, is really taking a small amount of upfront capital to get started. One thing to note on financing options here, I asked about small business loans for our business or early on in our business. And I wanted to say that many of the city startup initiatives I've seen in SBA loans are really targeted more at lifestyle businesses. They really aren't appropriate for the faster growing businesses that I spoke of before. And so, that's something to be aware of in a path that, at least in our own business, we haven't found too much success in to date. All right, so knowing that you're going to be faced down the road with a lot of decision points along the way, what's the face-off? What are the hard business decisions that are really going to impact your exit? This is the best picture I could find. It's pretty lame. Okay, let's go into the first one. Okay, so first big trade-off that I see. Technology investments and headcount versus cash runway. Do I make a big technology or product investment? Do I make a few key hires that I know I need? Or do I save cash? This is a tough one, right? Because in many cases, these investments will allow you to get to where you need to be to grow and to gain more customers. Some questions I would pose here. Can you get more nimble about building a minimum viable product and testing it? Can you continue to be scrappy just a little bit longer? Can you create manual processes in place of building technology? Just put cheaper manpower behind the technology and see if it works first. Can you stomach part-time or 1099 hires to do the job instead of hiring another full-time employee? Can your customers wait? Be honest with yourself. Will they forgive you for now? These two investments, specifically in technology and headcount, are really expensive ones. And they're hard to go back on. They're hard to reverse, particularly if you've already spent the money on technology. So if you're holding off of these investments could potentially save you hundreds of thousands of dollars in cash runway and buy you time, maybe it's something to consider. Another one we face all the time. Do I invest in marketing, blow it out? Do I invest in new marketing channels? What am I missing? What are new things we could be testing and opening up? This is another tough one because your economics and success might change as you increase marketing spend. What worked today might not work if you pump another $50,000 into it, or opening up a new channel is risky. It might fail completely. Therefore, the new marketing dollars, at least if you're talking about expanding them meaningfully, are actually much riskier than in some ways the ones you've already spent. So some thoughts here. Can you get more growth hacky? We do this all the time at Brideside. Can you go back to the drawing board and figure out new ways to get customers for free? We ask ourselves, what are we missing? What have we not tried? Can you get better at conversion? Can you do more with the customer base that you have today? It might be cheaper than thinking about how to acquire new customers. The main question really is, can you grow more slowly and just focus on the strategic priorities that get you maybe to break even or closer to profitability? What are the levers you can pull to get you there? Can you be more disciplined about only those levers? And finally, the age-old question on company ownership versus dilution. Now, I have to say here, I'm certainly not one to promote raising less money on account of company ownership necessarily. Penny pinching on ownership, in my view, isn't worth it because if the company does well, everyone usually does well. The situation I'm really referring to here is this. If you think about building for an acquisition or later stage private equity, it's important to hold on to ownership in the early days. Angel and seed investors take quite a large chunk of your equity in those early days. So it may not be in your best interest to raise a lot early and make big investments if you don't really know what your options will be later on. Again, you may want to think about how you can grow more slowly in the early days to figure a lot of stuff out before you take those larger infusions of capital. Again, to create optionality for yourself. So before we wrap up, I also want to say, you should always have a plan B, regardless of the path that you think you're going to pursue. You should understand, and I know I've said this many times, but you should understand alternative financing options for your business: corporate VC, strategic partnerships, banking relationships, other steady, reliable streams of revenue in case shit hits the fan. If you're truly shooting for the moon and are very comfortable with that binary outcome, that's awesome. It's great. But if you're the other 99%, you should probably have something else in your back pocket. And this involves investing meaningful time in building long-term optionality. I thought this was interesting. In the SVB survey, 50% of executives and CEOs expect their next source of funding to come from somewhere else other than venture capital. So again, you don't want to be scrambling at the 11th hour to figure out what these options are. Financing strategy really is your company strategy. That's what I've learned. The lights at the end of the day have to stay on. You have to constantly consider trade-offs and sacrifices in order to be disciplined about driving towards these financing milestones. And I will say, for those of you that aren't entrepreneurs, but are thinking about joining a startup, I encourage you to make sure that the management team understands this point and that you are comfortable that their company strategy and cash burn is aligned with a realistic financing strategy as well. So that's all I got. I'd love to open it up to questions if any of you have questions, and otherwise we can wrap it up.
Great, Nicole, that was great. Thank you so much for sharing all of this information. Definitely, as people let this process, send in your questions either through the chat box or the Q&A tab that you see in front of you, and we can take those as we go. Nicole, to start us off here, I'm wondering if you can talk more about how you developed your funding strategy for Brideside, knowing what you know about the state of venture capital, and also is there anything you would do differently if you were able to do it all over again?
It's a good question. Obviously top of mind when preparing this presentation. There's certainly things that we did plan for and things that I would have done differently. So on the side of planning, I will say that that comment I made around sort of that conversation with my dad did lead me to develop alternative paths for ourselves that actually saved us a lot on the ownership side and also bought us a lot of time to scale the business quickly. To be more specific, we raised an angel and seed round. We've raised about $3.5 million to date. And one thing we did was start to build a corporate strategic partnership with Hudson's Bay Company that allowed us to open several brick and mortar showrooms to test different markets quickly inside of the dress department at Lord & Taylor. Around that time, we also established some exclusive partnerships with our designers and invested in a lot of automations internally that improved our conversion that I talked about before. So I ended up raising less capital, which turned out to be a very good thing, and increased our run rate at a greater pace and built in some more optionality for ourselves longer term with a big strategic partner. So that was the sort of path that we chose to take. So, if we choose to raise more capital, we've actually ultimately have hit quite a high revenue run rate, and done a lot with very little capital that has been raised.
Interesting. Really interesting. Yeah, thank you for sharing all that and the insight into, your decision making. Another question, is there an example of a company, who has a funding strategy that you wouldn't necessarily use if you were them, or you personally wouldn't use it if you were their CEO?
It's a tough one. I would never say a company by name, but one of the I would say like motivations for this particular perspective and presentation is really driven by a lot of the students across colleges and business schools and also other early stage entrepreneurs I've met along the way that really are sort of building to raise money. And I think, and I will not, I maybe was very much in that camp myself early on, because that's the world that and that's what you hear about in the news. And I actually think there was a lack of resources around other options early on, and everyone, tends to have a pretty focused mind on that. So I have certainly seen, I would say largely at the seed stage, companies that are burning a lot early on to prepare for that Series A round, and just not seeing the same growth in Series A financing as I'm seeing in companies that are hoping for it.
Interesting. Yeah, great. Thank you. And we have Adrian writing in here asking a more specific question. Can you speak to the financing trends that you're seeing with respect to entrepreneurs starting clothing lines or fashion-related companies? With the changes that are taking place with retail overall, how is that affecting venture capital financing for fashion-related companies? And it sounds like she's looking for any advice you have to offer.
Mm-hmm. Sure, absolutely. It's definitely a very tough category from a venture perspective. My experience has been that a lot of investors have, both from venture capital and private equity, have really been burned on this category. So companies that ended up going under more or less like One Kings Lane, Fab, Gilt Group, sort of you name it. There was a big wave of capital several years ago going into these types of companies, and largely the capital structures were hard to scale. Whether that was that they faced inventory problems, or whether that the technology product was ultimately just not really sticky enough to justify all of that money that was raised. And I would say two things here. One is that my view is that a lot of e-commerce and consumer businesses have been overcapitalized and did not figure out enough early on their own business and margins and long-term customer acquisition strategy to really justify all that capital, nor do they really need that capital to become a big profitable business. So if you're in the earlier stages of this, I think there's a few important things to consider. One, the bar is just a lot higher for raising money. So you really have to show breakout success and breakout revenue success to get the attention of VCs if you're going to do a consumer deal. I would say the trends that are really hot right now are direct to consumer, so vertically integrated brands, a lot of retail technologies that are not actually consumer products, but are more technologies that are powering bigger retailers, whether that be in virtual reality or new tools that companies can use for geo-targeting to enhance the digital experience in store. Again, I would say if you're building a consumer products business, it's, I would actually consider sort of profitability and a path there as an important paradigm, and be very conservative on the upfront investments until you have meaningful customer traction.
Interesting. Yeah, Adrian, great question. And thanks, Nicole. We have another question coming in from Carl asking, do you expect the trend to high risk bang or bust VC focus to continue for the foreseeable future, or cycle back in the coming years where the lower risk, less upside companies might draw interest again?
It's a good question. I don't know if I'm fully qualified to answer that. It's, my guess is that, I think on some level I think capital efficiency is appealing at a certain point, but at the end of the day, I think the VC model, again, really requires that rapid growth, sort of breakout success scenario. I will say in the Midwest and anecdotally, there's definitely been more emphasis on capital efficiency and not the boom or bust mentality. And spending some time in the Bay Area, I think our company specifically gets a lot of credit for that capital efficiency, just relative to how little we've raised relative to the to maybe like a Bay Area company. So from that perspective, I think you can get credit for it. And I think it certainly helps your case to show that you're sort of a responsible entrepreneur and are going to be responsible with the company's capital. I think there's an interesting dynamic there of like the curse of conservatism, which is that you don't want to appear as too conservative, and they want to know that, your sights are really set on that big vision, that you know how to build that big company, you're willing to spend to do it. But on the other side, you don't want to be caught, in a sort of, in my view, like an Instacart or maybe even Blue Apron scenario, where once you sort of pick up the hood on what the unit economics actually look like, or even Uber that's still, losing over $1 billion a year, you don't want to be caught in that scenario later on where you still haven't really figured out profitability.
Mm-hmm. Yeah. Great question, Carl. Thanks for sending that in. And also, Nicole, can you, there's probably been a time throughout your company when you made a decision on, investing in tech or headcount, and in hindsight, you wish you hadn't. Can you walk us through kind of how you worked through that and the steps you took to kind of resolve those issues?
Mm-hmm. Sure. So I would say I can talk about a time that we didn't invest, and I'm actually grateful that we didn't. That I think suggests ultimately just one small example, and then a time that we did invest. So one example, early on when we were first starting the company, we actually our e-commerce site was pretty bad. It was like very much a minimum viable product. And what we found in a lot of the way our company's built now is that for this high touch purchase in bridal, it is a very sort of high touch customer experience. And we knew that we needed a lot of technology to help that process be high touch in a very scalable way, but we didn't really have the funding to build it. So early on, we were having a big conversion issue, and people just weren't buying dresses because, again, it was so high touch, but we didn't have the touch and we didn't have the technology. And my co-founder and I, we started doing these bridal expos that we'd go to, and we get these large, massive customer lists, like 1,000 names and phone numbers, and we just split it up and start going down and calling people and asking them the questions that they had. They heard of our company, whether they were looking for bridesmaid dresses. And we started going one by one and sort of providing this high touch service to customers ourselves, and starting to figure out, what they needed and what the process was really going to be like. Now, I will say that we have always tested new technology ideas with people. And we have a sales team now, and we have them processes all of the time. And what that gives us much more insight into the customer experience, so that when we finally invest in the technology and the processes, we see a much higher return on that. And one example of that is that we took a big technology bet last summer. We designed a few new pieces of technology and redesigned our front end user experience. And it was a big investment for us at the time, and it was a big risk. But what I will say is that I believe that we had so much consumer insight and data at that time, even though we were still a small company, that it was a very calculated risk. And the returns have been phenomenal. So our sales team output increased by around 30 to 50% almost overnight. Our conversion doubled. We saw these returns on that investment. But I will say, had we made that technology investment earlier on, I don't think we would have seen those returns. Another example on headcount is that I actually still help manage or do manage our sales team, which is now not only in Chicago, but in multiple East Coast locations as well. And I oversee the whole thing. And hiring a talented sales director and one that can scale a sales team very rapidly is a hire that we've held off on for a really long time. And in many ways, we did it for capital efficiency at the time. But I will also say that the longer you can hold on to things as a founder where it's appropriate, the insight that you gain is really invaluable. And I think it's also made us much smarter on how to scale the team and who we need to do it.
Interesting. Really cool. Yeah. Thank you for sharing that. And Nicole, Ernest is writing in asking, what fundraising strategies do you have for entrepreneurs that are not based in the major VC hubs? How can they engage both local and Bay Area investors?
Mm-hmm. I think it's important to spend meaningful time on the East and West Coasts, and I've done this myself. I would say it's twofold. One thing I think I could have done better over the years is not only building your investor relations on both coasts, but also building your entrepreneurial relationships on both coasts. Because at the end of the day, when you actually go to fundraise, you are going to need to target, fundraising takes a lot of time, and it's sort of a waste of time in some sense, and that your brain power should really be going to growing your business. So you want to make it as efficient a process as possible. And to make the fundraising process efficient takes a lot of upfront work. So the best way to be successful during a venture capital conversation is to get an introduction from a current portfolio company or someone that personally knows the investor well, and to sort of build out that network and get enough hits on the board, get enough people in that pool of target VCs. It takes a lot of time, and you want those relationships to sort of come from all angles. So the more time that you can spend just where the money is, having more casual conversations, attending events, so people can really know who you are, learn about your company, and the more entrepreneur friends that you can make to really give you insight into who they like on the venture capital side, the better. I also will say, I think proving yourself as an entrepreneur is a great way to get the right investor when you're ready. So early on, if you're way too early for a fund, but you have a real connection with someone, making that connection and updating them along the way, showing that you actually deliver on some of the things you said you were going to do, or you hit those growth milestones, just proves that you're very consistent, that you're high performing, and that you hit the goals that you set out to hit.
Yeah, Nicole, that's really interesting advice, and I'm just curious to go off of that. Does your advice change at all for entrepreneurs? Because we did a webinar 2 days ago with a very recent alum who graduated a few days ago, who is now pursuing his startup full time. With that being said, he hasn't really been able to really prove himself as an entrepreneur. Does your advice change for someone like that?
I think it's different for everyone and every company. And it really depends on the company you're trying to build. Look, if he has an amazing core technology that is hyper scalable early, then maybe that is something that raises, someone's willing to take the bet just because they like him, and you don't have to be proven out. And it really depends on what stage you are in the financing, right? With angel investors, no one's proven anything, and they really just have to like you, and that's fine, and that can go very quickly. It's, maybe if you're talking about sort of the later stage seed, Series A and beyond, that may have been, more of the advice I just touched on. And I think, early on, the ways that you can really prove yourself is, in my view, just having a very clear vision, being clear about what your value proposition is, how you are different, what your core competencies and competitive advantage are, and really just painting a vision for scale.
Mm-hmm. Yeah, that's really true. It all really depends. And Nicole, this is all really great advice. And I'm wondering, if more questions come in, we will take those. But I'm wondering if you have any, last advice, knowing that I'm looking at the poll. We've got a few entrepreneurs on, one aspiring entrepreneur on the call, a few investors, and then a few people who are probably just interested in this to learn more. Do you have any advice for any of these specific people before we log off for the day?
Go for your dreams. No, but yes, actually. I think by taking, my perspective is by taking the approach that I laid out here, it actually makes people better on both sides of the negotiating table, whether you're an entrepreneur or investor, or, by the way, looking to join a management team of an early stage company, and being able to ask the right questions. So, I think the more empathy that you build for either what the VC needs, and if you're on the investor side, what the entrepreneur needs, the more empathy and open communication and feedback there is there, I think the more successful everyone will be in this journey. So for me, that's really, really the takeaway. And as always, happy to be answer additional questions offline. My email is nicole@brideside.com, and feel free to email me as well.
Yeah, that's really helpful. Nicole, is that all right if I post your email address on the webinar homepage?
Sure.
Great. Well, Nicole, thank you so much for all of this information. I know it was really appreciated by everyone who joined us today. Is there anything else you'd like to share before we end today?
I don't think so. Have a great day, everyone.
Awesome. Thank you again, Nicole. And thank you everyone for joining us for today's presentation. To find all of the archived and upcoming webinars, please check out the full webinar website through the NAA at alumni.northwestern.edu/career webinars. Have a great rest of your day and go Cats.